Good afternoon. I'm here on behalf of our team leader, Green Moore, from the Audit Department of Alex Gold and Financial Services. My team will conduct an audit for Sheridan Audiovisual Limited using the reports and accounts of 2020 and 2021. Our presentation will be divided into three parts. The audit plan, the audit risk assessment, will be divided into inherent risk and control risk, and finishing with tax advices for the company. With the information provided and by visiting the company's website, we have learned that Sheridan Audiovisual is a home theater equipment company. Therefore, the company's primary source of revenue will be from providing home cinema products and services. By analyzing the company's business model and partners, we have primary understanding of the company's operating data. Suppliers and market conditions were identified to better discuss cost and analyze company operation. In addition, we will examine accounts to discuss the potential risk. We plan to divide the account into various categories to facilitate the examination. By analyzing them separately, we will be able to obtain more detailed conclusions. In addition, we will compare the audit results of each department to further justify the audit risk. After confirming the reasonableness of the audit risk, we will investigate the potential impact of the audit risk. Finally, based on the audit risk and findings, we will provide strategic recommendations for the company to comply tax requirements and reduce accounting risks. So, let's move on to the audit risk, which has been classified as inherent risk and control risk. So let's start with the inherent risk. As we know, this company works in the cinema industry, which means they need a high demand of technology and research. This industry faces fierce competition and challenge with rapidly changing and development of technology. Those external environment factors might lead to decreased profits, margins, increase in inventory accumulation, which has impact on company earnings. Secondly, according to the income statement from 2020 to 2021, we have found that the revenue has increased significantly in 2021, but distribution and administrative expenses kept stable. It can be seen that the operating profit ratio has grown from 5.3% to 10.24%. This remarkable growth might result in additional manipulation of the financial data and false sales income. Our analysis based on incorrect sales data might result in an audit conclusion that does not match the company's actual situation. Furthermore, the amount of plant and machinery listed in non-current asset does not match the amount in the financial statement, which could increase the possibility of providing misleading information. As shown in the graph above, in the left side graph, we can see that the total carried forward is £505,500, and in the graph on the right, the cost carried forward is £506,186, with a difference of nearly £1,000. The risk might be that the complex valuation approach might wrongly increase the calculation of non-current assets fair value. Additionally, the total carry value of non-current asset grow rapidly in 2021. The company might increase the risk that they implement the value of additional asset in their non-current assets in order to increase the valuation of non-current assets. It will impact the judgment of the company's long-term debt capacity during the process of audit. So, based on the financial data that we were given, our team is going to give some suggestions about how to deal with the inherent risks. First of all, the company needs to enhance measuring procedures to increase the accuracy of asset valuation calculations. Secondly, they need to increase product research spending to stay up with technical advancements in the industry, in the cinema industry. And thirdly, improve the professional skills for department staff so they can contribute more to the company and work better. Now we'll move to the control risks, and I will pass this to my colleague.
Control risk is a significant component of audit risk. First, our team leader has been talking to Rose and have found the following additional information about control procedure of non-current assets. Only one person is responsible for checking the non-current asset listing, which means the unauthorized purchase will be increased. There is also an increased risk of asset valuation being incorrectly recorded in the financial statement. My team have investigated about sales process. We found when the goods are dispatched, the copy of goods notes is received by Rob in the warehouse. However, the sales department doesn't receive the notes at the same time, which could cause the loss of revenue due to sales department cannot record transaction on time when the goods successfully dispatched. According to cash sales made through the retail shop in the mail, Mark does an independent cash check and records. This leads a lack of segregation of duty. There is a fraud risk as Mark may remove cash and then record the incorrect amount on the sales list. As a result, there is a fraud revenue in income statement. We also inquire their staff and observe an inventory account process. We found that Peter and Rob are the staff in the warehouse. They also participate in the process of accounting inventory. Because they are not independent person from inventory, which may lead to intent hiding or missing inventory as a result in the incorrect value of inventory on the report. And based on the previous audit analysis, there are some control risk suggestions for the company. First, company should improve segregation of duty for staff. Secondly, the company should enhance the allocation of management authority. Third, relevant staff should be responsible for regular review and check the important daily sheets. And finally, we have some tax advice for the company. Firstly, as a home cinema product service company, Sharon AV should need to establish business relationship with wide range of raw material partners. Many smaller suppliers operate by refusing to provide an invoice to avoid tax. Therefore, we believe that Sharon AV should pay more attention to compliance and tax rating of transaction when working with the suppliers. Companies should avoid missing invoice and tax enroll in suppliers' raw material transaction. Tax evasion can help reduce a company's operating costs in the short term, but in the long term, it can create more risk to the company's financial figure and operational compliance. Secondly, we recommend that companies should standardize its business process and financial reporting procedures. It should provide detailed description of project reporting procedure and more complete process oversight to ensure that day-to-day operating expenses are properly recorded. That's all. Thank you for listening.